Yeah. Where's all my guys at? Cliff Peebles. Sean Graylish. Who else is here? Chris Hayes? The Chris Hayes? Dave Airy. Debbie Dantes. Roger's here. Adam Evans. What's happening? Everybody's here. I have some announcements to make before we get started. First of all, you see that shirt Michael Batnick's rocking tonight? That's the official Chart On.
Who made this?
Me and Duncan. It's a collab. We worked on it together. It's cool, right?
Love it.
It's like a throwback. It's like very like 1980s.
Oh, there it is. There it is.
Yeah, we're offering it in premium navy. One colorway.
It feels very good. Like that's good material.
It's like the nicest thing we've made so far. All right. So anyway, that's available on iDon'tShop.com. You guys have been asking us for that for a long time, and now it's here. So I should have worn mine tonight. We should have matched. Okay. We have a lot to do. I want to announce two things. The first thing, next week there will be no show because we're going to be at Future Proof. So wish us luck. It starts on Sunday night in Huntington Beach, California. We'll be out there till I think I'm leaving Wednesday night. Mike, when are you leaving?
Saturday to Wednesday.
Saturday to Wednesday. All right, I'll be there Sunday to Wednesday. Few thousand people coming out for that. We're gonna definitely do some podcast stuff out there, but we're not gonna get to this show. So next Tuesday night, you have the night off. We have the night off. We're trying out a new format tonight. You guys really seem to have responded to us pitching stocks and stuff. So each week, one of us is going to make the case for a different stock and try to convince the other. We're also going to break out a mystery chart again. You guys were really into trying to guess along with us what the mystery chart was. So stay tuned for those two things at the end of the episode. Viewer topics are going to move entirely to Portfolio Rescue with Ben Carlson. So we do that live every Thursday at 11 a.m. And Ben and Duncan do a really great job. So keep the viewer topics coming. We're going to let Ben, who's smarter than both Michael and I, handle the viewer topics. Am I missing anything?
No, well, one last thing. Y charts.
Sponsor.
Do you know what I use Y charts for? Everything.
I feel like I don't want them, though. Or do I? Go ahead. What do you use Y charts for?
Everything. I was just looking at some margins. I mean, it's all right here. Whatever I need.
What happened to your voice? What happened to your voce?
I went hard. I went hard this weekend.
You did?
No, because I it's a whole thing. I had a cold. Went too hard. Blah blah blah.
Went too hard. With your kids. All right.
Yes.
Y Charts, best sponsor in the world. We love Y Charts. If you've never used it before, you have a discount available. So make sure you use the link below this video. If you're at all engaged in any kind of research, economic, stock market, bond market, commodities, cryptocurrency, you name it, Y Charts is an awesome resource. We use it every day. Okay. The first thing we're going to do tonight.
Something else? It's my turn.
I think it's
starting.
you. All right,
I'm
go.
starting. All right.
Rock and roll.
So J.P. Morgan's Guide to the Markets just dropped. They do one every quarter. And we've shown this version of a chart before, but what it does is it's breaking down the sources of a return for the S&P 500 year to date. As everybody knows, stocks are down this year to the tune of 13%. However,
more.
Okay, fine, whatever. However, earnings are up 6%. So the difference, how do we get from earnings growing 6% and the S&P 500 being down 14%? All margin compression. Multiple compression, I'm sorry.
Multiple compression.
Yeah.
Wait, so the PE ratio is down 19% year to date?
So what did it go from, I don't know, 24 to 19?
That's what it says here. So part of me feels like that's not enough. And now you're going to get earnings rollover too. Not to like start off on a bearish note, but if a lot of the valuation support in U.S. stocks has been based on low rates, and we've just had one of the quickest reversal from low rates to, like, let's say average rates or normal rates, I don't know that that's enough. What do you think?
Well, I don't know either. But I do know this. For the first time in like a long time, based on traditional valuation metrics, we're on the right side of normal. On the PE, 25-year average, 16.85. Latest, 16.65.
So we're getting there.
Cape ratio still elevated. Dividend yield's good. Price to book's good. It's all basically in line.
Okay. So at the current multiple, if the worst case scenario is $200 a share in earnings for next year, where would that put the S&P?
It's
Pretty much right where it is.
What is the S&P right now?
Like the range of earnings expectations, the bulls are at 230, the bears are at like 200. Let's say it's 200 at 16.5 times earnings. Where would that put the S&P 500 at the end of next year? Not that it actually works that way.
3,300. Where are we right now?
39-ish. So today was another ugly day, but it wasn't that bad.
So what they do in this guide to the markets is they break out the S&P 500 x the top 10 stocks, right? The top 10 tend to bring up the average multiple. So the S&P 490 is trading at 14.6 times projected next 12 months earnings.
So that seems very reasonable.
I think so.
Yeah. All right. So you feel like we're getting to where we need to get to. You really need earnings to hold up, though. Like let's assume we've seen the worst of the multiple compression, or like there might be a little bit more, but how much more could there be?
How much?
Now you really need the E to hold up.
I should probably know this. How much do earnings get hit in a recession? I'm sure it's all over the place, but
it's all over the map. And you know what's really makes it a moving target is that the sectors that dominate the S&P change too. So it's like how much do earnings get hit, but then if they really got hit in that sector 10 years ago, does that sector matter as much now? And so it's kind of like it's like putting a puzzle together.
But whatever. But what is the S&P 500 earnings? How much does that contract? Forget specific sectors.
Just overall.
I don't know.
I don't know. I have to believe it's more than 10% year over year, but I could be wrong. I could definitely be wrong. What's this summary of 2022 performance?
Modest Proposal tweeted this chart today. It's just pretty ugly. I know you can't tilt your head to the side, but what they're looking at is the internet down 48% year to date. The universal average that they cover. Market cap weight, it's a little bit not as grisly. The median's down 49%. I mean, these are ugly numbers.
So the S&P down 17 and the internet down 50 is really bad. You know that thing where like at the beginning of every year, they ask like chief strategists, like what sectors do you like for next year? For the last like 10 years, it's just been so easy to be like tech. We like tech because there's so many stories about how tech is like enterprise spending is like not cyclical and like companies. None of that really matters. If people are selling the stocks in that sector, the story will fall apart really quickly. And that's exactly what happened with technology this year and internet in particular. And it could 100% persist through the end of this year.
What looks so gnarly. So Disney filled the gap and then some. Like it's basically had a great earnings reaction. It's been straight down ever since. Netflix is rolling over pretty hard. Warner Brothers closed at a 52-week low. Paramount closed at a 52-week low. All of these streaming stocks are disgusting.
And they're not even in the internet basket. I don't even think Netflix is. They're communication. They're in the communication sector, right? All the streamers, yeah. So they're not even in the tech basket.
Apple too. You looking at Apple?
Apple's actually in tech.
Straight up since earnings report.
Yeah.
And like the 2 weeks after, then straight down.
Yeah, and these are like big market cap stocks. So if they're not going to hold up, and energy that's not going to be enough to keep the market steady.
Microsoft also looks really bad, and Facebook. When is this going to break? It looks like it's going to break, right?
Yes.
That's not going to hold.
I think if Meta gets into the low 150s,
that's not going to hold.
It will go like that's literally support. So it's sitting on support right now with no potential good news in sight. And this guy's uploading videos of himself doing MMA. So I don't really know what's going to happen there, but I don't like the looks of it. All right, let's keep moving. I wanted to go over the 60-40 portfolio thing. Bank of America says it's on pace for its worst year since 1936. And that's like 90 years ago. And I would just say that there was no such thing as a 60-40 portfolio in 1936. Nobody had ever heard of such a thing or spoken openly about anything like that. I don't even think people were talking about stock bond mix until like early 1950s, Markowitz. I could be wrong, but that's what I think. So we'll roll with that. So basically the point then is this is the worst year of all time for the 60-40 portfolio.
Basically.
Right? Like, is that a fair?
Well,
is that a fair?
Well, it's 100% the worst beginning 8 months of a year. Look at these. Throw some charts.
No, so I'm saying on pace. All right.
Forget about on pace. It is.
It is already. According to data from strategists at Bank of America Global Research, the 60-40 portfolio, which is a mix of 60% stocks and 40% bonds, was down 19.4% year to date through the end of August. Got a little worse today. On track for its worst year since 1936. Through the end of August, the S&P 500 was down 16%. Long-term treasuries were down 20%. Investment-grade corporate credit was down 13%. John, pull that first chart. How do we explain what we're looking at here, Mike? Take a crack at this.
What are we looking at?
It's like the month. How many months
I got it.
stocks and bonds are both negative, and how many years?
So stocks and bonds are both negative 15% of the time
On a monthly basis.
Just 1 month.
Yeah.
For a 3 month period, that goes down to 8.5%. For a 6 month period, very rare.
So less than 4% of the time over rolling 6 month periods since 1976 were you down in both stocks and bonds.
Yeah, I don't like this chart.
And then what's beneath that? Is that the magnitude?
No. Beneath it is how often is the 60-40 portfolio negative? The top bubbles are showing when they're both negative.
Oh, so that's the blend.
Yeah.
Okay. So this is really interesting to me though. Like in any given 3 month period, the 60-40 has a 25% chance of being negative. Were you surprised at all by that or not really? I would have thought less is what I think I would have thought like 10% of the time, but I'm wrong. That's really interesting. I guess like the 70s really punch above their weight in moving that average. Is that like the best explanation for that?
I guess.
70s, early 80s.
Throw up some of my charts that I put in here, John. So this is just using the broad bond index and the S&P 500. I had down 14% from January through the end of August. And the next chart shows it pretty clearly. On the bottom, you've got the S&P 500. And then along the side, you've got bonds. And obviously, one of these is a humongous outlier.
Dude, that's a huge outlier. Look at that. And not just because you colored it red. Look at how deep into that quadrant it is. So it's really, I don't know what that other dot is that's in the same quadrant, but there's only one other year where both are negative in this 8 month period. Right? Am I reading that right?
Yeah, but it was tiny. It was like -5 and
it was literally no big deal. It was single digit declines in both.
Right.
So wow, this is
that was 1981, by the way.
This is really incredible. Let's go to this 10-year Treasury rate, 1 year change.
So this has done some damage. The 10-year is up 200 basis points over the last year. Hasn't had that magnitude of a move since January 2000.
And the 2 year is up more.
Is it?
The 2 year is 360 right now. What's the 10 year? 335?
Yeah.
I mean, it's incredible what's gone on in such a short period of time. But all right, here. Over the last 46 years, investors never encountered a 3 year span of losses in both asset classes. And then the analyst is quoted as saying, the goal of a 60-40 portfolio split between stocks and bonds is to achieve annual returns of around 7% on average, which is not bad. But it's very rare that you'll hit it on the nose. So JP Morgan says the S&P, for example, is averaging just over 9% since 1980, but only 1 year did it actually go up 9%. So these things rarely do the average. So the point with a 60-40 is that we've had above average returns for that classic portfolio for a long time. And a year like this year is nature's way of, I don't want to say like getting back at us for that, but evening things out.
This is the stat to me. During the 3 previous years, a 60-40 portfolio delivered a 14.3% annualized return, which is obviously ridiculously high. So even after a 12% decline for all of 2022, that would bring the 4-year annualized return down to 7%.
Which is the historical norms. That's the historical average. So it's like a perfect example of mean reversion taking place. You had 3 years of way above average, and now you have 1 year of way below average, and that knocks it right back to the long-term average, which is why long-term averages are so important to understand. Ben did a couple of 60-40 charts here. Let's get through these. These are the worst years of all time for a 60-40, not including 2022. And you can see there's a very easily recallable reason on the right side explaining why shit was so bad for stocks and bonds at the same time.
What do you think we're going to call this period of time? It doesn't have a name.
Inflation only. Inflation. It's the whole story. It's not hyperinflation.
No. I know that's a reason. I'm just saying, what will we call this period of time?
It'll be like stagflation or COVIDflation or some shit. You know what I mean? We had one of the greatest speculative manias ever from March 20 into February 21. Basically, we had an absolute free-for-all for a year. And then interest rates had to normalize and inflation kept getting worse. And now the Fed is tightening into a downturn, possibly a recession. So that's what we'll remember this. I don't know what the 3-word thing will be, but it'll be something themed that way. Unless Trump wins, in which case we'll call this the Biden Dark Ages. We'll see what happens. Pull up the worst 5 years for a 60-40. Food for thought. So 3 of these years are in the aftermath of Great Depression / onset of World War II. 4 of these years, the first 4. And then 74 and 77, obviously the same cause, the stagflationary 70s. Let me see. But those are still positive.
But real was definitely deeply negative.
Real was obviously worse than. Yeah, listen, I think a lot of this stuff, though, when you glance at these years, like in your head, you can deconstruct what was going on. Let's do the worst 10 years for a 60-40. There's not a single. Yeah, but I'm saying there's not a single 10-year period that's negative, and of course these are not inflation adjusted. But so what?
No, while these numbers are true, they're not really helpful. It doesn't make you feel better in real time. 10 years is a long period of time.
Yes.
I know the answer is zoom out and be patient, but in real time it doesn't help.
But Mike, if you were a long-term investor in 1998 or starting in 1999, and then that 10-year period ending in 2008, it was gut-wrenching. You went through 2 50% crashes.
Not worth it.
In the S&P. But you still ended up plus 31%.
You were not rewarded for the risk that you bore. In that 10-year
period.
Yeah.
No, 100% agree. Yeah. But you still, if you just did nothing, you didn't walk away empty-handed. I think that's really the point. That's probably as bad as it gets.
I hope so.
I mean, yeah, so far.
Yeah.
That's pretty much all right. Worst 20, real quick. All right, I'm gonna quote Ben. As you guys look at what's on the screen, there's never been a negative 10 or 20-year period for the 60-40 portfolio going back to 1928. The range of annual returns for the worst 20-year period for a 60-40 is 3.4% to 6%. That doesn't account for fees, taxes, or inflation, of course. From 1982 through the end of 2001, a 60-40 mix of U.S. stocks and bonds rebalanced annually returned 10.8% a year. Stocks did 12.2 over the same period with 33% more volatility.
Well, that's not going to happen again.
another 40 years of 10.8% a year for the 60-40.
Yeah.
That would be tough, which is why I think you're going to see alternatives boom in popularity. And then some people will pick the right alternatives, some people will pick the wrong alternatives, but that is definitely where this is headed.
It already is.
All right, let's keep moving.
There was an article on Bloomberg today. Retail trading army is seeing power wane in stock market it once ruled. I actually was very surprised looking at this chart that retail hasn't really gone away at all. I mean, sure, they're not. This is the volume that they make up of the overall market, and it peaked in.
Retail is the blue line.
Retail is the blue line.
We're
But
saying
they're
it's
still-
17.5% of what, daily trading volume?
Yeah, so
stocks?
look at where they are compared to pre-pandemic.
I wonder what they look like in the options market. If they're much bigger than this or smaller. There was one point where they were like half of options volume.
But given that so many of their favorites are down 80, 90%, what did you think that would leave a bigger mark?
So this is not about ownership of the stock market, directly owning stocks.
It's
This
volume,
is just about
trading
daily
volume.
trading.
Yeah, they're not leaving.
This is probably what I thought it would be. I would have said somewhere between 10 and 20 if I would have had to guess.
Did you know that? Did you know that there is a meme ETF? Roundhill has one.
There is that different than the social buzz one? The
Yeah, it's
Van
different.
Eck one?
That's
okay.
different.
What's in the meme ETF?
So the top
Exactly what I think it is.
Snap, Robinhood, Rivian, Zoom, Nordstrom, Coinbase, AMC, Best Buy, Twitter, Beyond Meat.
How much money is in this?
Not a lot. It's down 62% since it launched in early 2022.
I mean, we like Will Hershey, and
Love
he's
Will
super.
Hershey.
He's a super creative guy, and he's great. But like, what kind of a dickhead is long this thing? Honestly, sorry. I mean, I get it. I get it if you want to trade it. Like if you think this basket got oversold and you want to get long, but like, is somebody investing in the meme sector? It's not even a sector. It's a hodgepodge of randomly selected stocks that, for whatever reason, caught fire on
No,
chat.
there's no
There's
money
no
in here.
factor.
There's no money in here. But my point is, this basket of stocks is down 63%. And yeah, people are trading other stocks, but the fact that they're still that they're still trading to the extent that they are surprised me. Did you know that the SPAC ETF got delisted?
Yeah.
Look at fill up this next
JC
chart.
wrote about that this weekend.
Gone.
This should get delisted, and then the person who came up with it should be executed. So also,
You don't mean that.
well, no, not really. No, I'm just kidding. No, but at the very least, like that person should have a yellow card. So like the next time they are about to create an ETF, like they have to think twice about it or something.
I actually don't think that there's any ETF that's too offensive to bring to market.
You really don't? I find every ETF brought to market to be offensive. So that's just a difference of opinion. The idea that we really need 900 different indexes is laughable to me. And now we're just creating things out of thin air that have zero meaning whatsoever. The whole thing is offensive to me. But I think for every ETF that is listed, I think 5 should close. I'm sure that is how it is. I know there's a lot of closures that we just don't hear about because nobody cares. There's no money in most ETFs.
Right.
So most of the money is concentrated into the top 20 or 25 ETFs. So it's not really a problem. I think it's fine. But not every jokey, silly thing deserves its own index. The good news is these things weed themselves out. Nobody has to pass any laws or any rules. What are retail investors doing now? If their favorites are all down 90%, are they all oil stock traders now?
I don't know.
What do you think they're doing? You think they're shorting? Like you think more retail is shorting the market this year than ever before? I could picture that.
Yeah.
I could be convinced of that. I think they're doing leveraged ETFs from the data that I've seen, like 2 times long, 2 times short. I think they're day trading with that. I don't know. It's not something that I think is terribly important. I know there were a lot of people in early 2021 that were like, this is going to permanently change the structure of the market. No, it's not. Just a lot of money will get lost and people will go find something else to do. Doesn't that seem like that's how it's winding up?
Yeah.
So I think it's fine. All right. Speaking of memes and retail, Bed Bath Beyond. What's going on here?
Well, I think I spoke about this. I listened to the conference call in July, and it was sad. It was the worst call that I've ever heard. One analyst was like, "Best of luck." Like whatever they tried to do, it didn't work. Obviously,
Okay. Specifically, we had a guy jump out of his window in Manhattan, the CFO of the company. And now, if you thought there were conspiracy theories around meme stocks before this weekend, prepare, because from what I've seen is now there's talk about this lawsuit. This guy was named in. It's, by the way, it's the most horrible thing in the world to get into a situation that you feel like there's no way out of, and that's what it seems like this guy's situation is. And I have no opinion whatsoever of like whether or not he deserves to be investigated or sued or anything like that, because I just don't know. But that's what the message boards and Twitter, etc., seem to be ablaze with. And like from my perspective, let's say he's guilty of whatever you think he did. This is a guy with a wife and kids and probably a lot of people that love him. And the crime of doing whatever you're assuming he did, pump and dump or whatever, is not, in our society, is not the death penalty. So like I feel like before you take to an online message board or to Twitter to start accusing people of crimes or wishing ill on them, remember like it's a person and it's not just a headline and it's not just a tweet. And people have feelings, and I think this is a really, really sad story that should maybe make people think twice before they assume they know everything that's gone on. But with that being said, there's like allegations that this guy's been in talks with Ryan Cohen, and there was some news announcement that coincided with him selling his whole position. Things are getting like really nasty here. Would you agree?
yes, and we will learn more over the coming weeks.
Yeah, I don't think anybody really knows anything for sure, but there are like a lot of stories happening here.
But I just assume that this company will do the Chapter 11 thing.
They named an interim CFO today. Too soon? I guess they have no choice. It's kind of a emergency situation.
Anyway, again, just reiterating the fact that it was the worst call that I've ever listened to. They tried to do a turnaround. They went into like private label brands, and it all went really, really poorly.
So they also had to announce huge layoffs in conjunction with the selling by Ryan Cohen was this announcement of like a really big restructuring. And I don't think there's any CEO or CFO in the country that wants to be on the delivering end of that news, which obviously also could add to somebody's like anxiety. So
all right.
Anyway,
Let's move on. Asset managers and hedge funds are record net short U.S. equity futures. I just feel like the numbers just keep getting bigger, and we just keep seeing more records. And I guess because this is a dollar amount, it's not terribly surprising, but they're going after it.
let me say. Where does this number come from? This is asset managers who are long short, whatever their short positions are.
No, they're looking at S&P 500, Russell 2000, NASDAQ 100, S&P 400, and Dow Jones futures.
So what would change this other than a V-shaped recovery back to the highs?
I mean, but look at, so we did have
They don't seem to want to go away.
we had a pretty heavy rally there from the bottom of June through middle of August, and they really didn't budge at all. They didn't back off.
We had a 17.5% rally from the middle of June into the middle of August.
Okay.
Which is, it seemed like a mother of all bear market rallies, and it was in that we had recaptured 50% of the loss, which is a big deal. But then Sean and I were working on something and looking at the 2000 to 2002 bear market, which I still think is the best analog for the current bear market. There were 5 bounces that year, or during that 2-year bear market. 3 of them were 21% bounces. and then one was like 8% and one was 18%. So a 17.5% bounce, which was what we just had, is like right in line with what we've seen during previous bear markets. So I still feel as though the shorts are sticking around because they understand that there's going to be that big rip and they're willing to sit through it. And so far that looks like it's been successful for them.
So Apple almost retook its highs. Apple was like less than 3% from new highs a couple of weeks ago. And
that's the only stock. And that's the only stock that really matters. If it retakes its highs, yeah.
Straight down since then. So I don't know if these charts are terribly important, but it's just interesting where positioning is. But meanwhile, given that the Fed is removing liquidity, trying to slow down demand, housing market seems to be rolling over, data seems to be softening. For all of that, the S&P is down 12% in the last year. That's it. And I know obviously
1 year chart.
I know obviously other areas of the market have absolutely imploded in spectacular fashion. But the 500 biggest stocks in the world are not really doing that poorly at all, actually. They're really not.
Yeah. I think Exxon and Apple are doing a lot of the work here. I mean, we know they are, but I'm saying I feel like that's really keeping this from looking as ugly as it does. And you've done like 10 posts on this, how looking at the median drawdown in stocks is more meaningful to the lived experience of most investors.
Totally.
Like most investors are not just sitting there holding Apple.
I think the index is definitely masking most people's reality, for sure.
All right, we do this quick thing on crypto. Barron's, I don't know if this was their cover or not, but Barron's was like, never mind Bitcoin, buy Ethereum, which is a take. It's not the kind of take you would expect from Barron's.
That's not. I read the article. That's not what they said.
Yeah, they did.
No.
They did. That's literally what they said. They're saying Ethereum is the closest thing crypto has to its own internet.
So?
And they're basically talking about the merge being this catalyst that is going to be much more meaningful for ETH than for Bitcoin. And I mean, obviously, but I just thought it was interesting that Barron's is actually getting, this is Joe Light is the journalist who does great work for Barron's all the time. I was just fascinated with the idea that Barron's is getting that specific into crypto. But basically, what's happening here is this blockchain is going to go from proof of work, which is ecologically ruinous. The current system, Ethereum, is utilizing as much electricity per year as the Netherlands, which obviously is outrageous. But they very boldly are going to merge the old ETH chain with a new chain that is proof of stake. And so it'll be much more environmentally friendly. It'll be a lottery basically for validators on the chain to make a decision that a transaction happened that doesn't require burning down the atmosphere. So for whatever reason, people seem to be really excited about that. I also think that it's going to burn off more ETH and lead to more of a scarcity.
It'll be less
ETH.
inflationary. I think they said about 4.5% of supply is coming on a year now, and that'll be reduced to 0.5%, something along those lines. Meanwhile, crypto still looks like garbage. As does
did Bitcoin make a new low today?
No, not yet. As do all risk assets, but ETH is outperforming Bitcoin by a lot, up 40% over the last 3 months. Ethereum compared to Bitcoin. But I just made a simple chart of the 200-day moving average of Ethereum, and it's below it pretty significantly.
And it's interesting. It like failed right where the whole Nasdaq failed. You see that, and then rolled back over. I feel like it's a very similar chart to most technology stocks.
So crypto in the last couple of months, it bounces when stocks bounce, but not as much. And when stocks fall, it falls harder. So not been a great place.
Put up Bitcoin and Ethereum together. So it's neck and neck this year. The question becomes though, which one seems to be gaining in relative strength?
Well, I'm telling you, if you look at a ratio chart, ETH looks way stronger.
I guess because there's like a catalyst for ETH and there's no real catalyst for Bitcoin. I mean, is it that simple?
I think so.
So these are just like stocks then to me. You know, they're stories. And sometimes the story is great. And right now the ETH story seems great. If they can pull this thing off without like completely destroying the whole ETH ecosystem because there's some accident with the code, like if this actually works,
I feel like they've been talking about this for years.
yeah. Well, this is it. Is it Thursday or something?
September 15th, I think, is on or about.
Next Thursday. All right. So this is it.
All right.
So we'll see what happens.
All right, I'm going to make the case
right,
for Dollar General. Last week on Animal Spirits, I spoke about how Dollar Tree sounded completely different than Dollar General. I listened to both the earnings calls. Dollar Tree bought Family Dollar in 2015, and I don't think it's gone so great. Last week on the call from Dollar Tree, they said, our suppliers are being hit with inflation. This, along with our commitments to the competitive pricing and the value proposition, is expected to negatively impact our gross margins in the near term. Stock got killed. Then I listened to Dollar General. They said, the quarter was highlighted by comp sales growth of 4.6%, a slight increase in customer traffic, accelerated growth in market share of highly consumable product sales, including in both dollars and units, and double-digit growth in diluted EPS. Our second quarter performance was led by stronger than expected sales in our consumable. And so anyway, it was much more upbeat. They raised guidance. And so I'm going to take you through the case, Josh, and then I will pause and allow you to retort, agree, disagree, whatever. By the way, I do not own Dollar General. And this is definitely not a buy recommendation. But I am making the case. Chart on, please. So you see in 2015, when Dollar Tree bought Family Dollar, that the revenue was roughly equal to Dollar General.
Oh, wow.
Right?
Look at that. Yeah.
So Dollar General has been out executing them. I'm going to lean on some charts from Alex Morris. We had Alex from the Science of Hitting on the Compound and Friends a couple of weeks ago. One of my favorite Substacks. All right, Dollar General. The store count is going up. There was a crazy stat that 80% of their stores are within 5 miles of 75% of the population. I'm making that up, but they're basically everywhere. That's the TLDR.
That's like Walmart. Yeah.
Yeah. But Walmart is.
I'm sorry. Stop. They have 20,000 stores,
and they're out executing Walmart. So
that's a lot.
it's a lot of stores.
Yeah.
Dollar General is going to earn 70% more per share than what they did in 2019. Walmart is going to earn 20% more than they did in 2019. So look at the blue line. Look at the blue line compared to 2019 pre-pandemic. Night and day. And Walmart's basically like eking out a little bit better. And Dollar General is buying back stock. They're shrinking their share count every year. And best of all, the stock is actually working. So I like to look at the 200-day moving average without the price. It just tells you a much cleaner story. So next chart, please. This is just the 200-day moving average.
I've never seen this before.
So
I love so on Y charts, you create the stock chart, add the 200-day moving average, and then pull out price.
Pull out the price.
Or level or whatever.
Pull out the price. And then the next chart shows you just obviously the price is noisy, right? But
that's hot.
But it's going up. And in this environment, I feel like even if things do soften, people will still go to the dollar store and they're executing. Their margins are higher than Dollar Tree significantly, way higher than Costco, Walmart. They are doing good things.
I like it. Just like purely on, first of all, I don't think I've ever been into a Dollar General in my whole life, but I was reading that like 80% of their business is consumables. You know what consumables are?
Things that you consume and throw out. What is it?
Yeah, things that you have to keep buying all the time. So like food or Ziploc bags or paper towels. It's like not like Target has to sell a flat screen TV to make its margins.
They're small on that. There are things that they're toilet paper, shampoo, things like
That's
this.
my point.
Things
Consumables.
you can't live without.
Yes. So they have a higher percentage of their sales in consumables than does Walmart, Target, etc.
They didn't bury themselves in the wrong inventory because their inventory turns over all the time.
Yes. So to me, this is like an amazing. These are like the right charts to be. This is the right pond to be fishing in this market. If you have a stock that's within 5% of a record high, they're doing something very right. Doesn't mean you'll earn the highest returns, but I feel like that's not like the worst mentality to have.
No, and this is not going to. This is
market.
definitely not going to be the best performing stock by any stretch of the imagination.
Especially if the market turns.
But it's a type of business that you can actually buy and stick away, as opposed to most stocks. You know, most businesses are not worth earning long term. I feel like this one is.
Okay. We're going to do a mystery chart real quick, and then we'll get out of here for the night. I wanted to pop this and see if you had any clue what this was. But before we pop it, John, hold on. I would give you a clue.
Okay.
I would say that some people think this is the most important chart in the markets this year. Like, I don't think it is. I think it's up there. But there are people that we know who would say, like, this is the whole shooting match. All right.
Are you
John,
getting cute with me? Is this just straight price? Hang on, John. Is there a ratio in here, or is this just price? Is this just price?
No. I just told you. This is the price of something compared to other prices of some other things. No
so
ratio,
it's a ratio chart.
It is not.
All right.
John, chart on.
Okay.
All right. So this starts at the beginning of 2022 up until today or yesterday. And actually, this originally came from the Wall Street Journal.
I know
what
this
is
is.
Go.
The bottom is the NASDAQ, Dow, or Russell and S&P, and the top chart is either the 10-year or the dollar.
Final answer?
Yes.
You want to ask anyone on the stream? They can't help you. Let's see. Kevin King says oil versus tech. No, it's not oil. Maybe oil related. Let's
dollars,
see.
No?
A lot of XLE guesses. It is not, sir.
It's not the dollar?
It is a dollar. You didn't say that. All right, let's go.
Hold on. What are you talking about? I didn't say the dollar. I said it was either the dollar or the 10-year.
No, you said the NASDAQ. What?
I said the
am I
bottom.
losing my mind?
I said the bottom charts. I thought the bottom charts were stocks, and I thought the top one was the dollar.
All right, you got the top thing right.
Okay.
You did. There are people, JC is one of them, that are basically like, look, until this reverses, there's really no hope for stocks. And I understand it. I was surprised to see what the Japanese yen is doing.
I heard weakest since 1989 or something like that.
I don't really fully understand that part of the story. The Europe and British pound thing is like really intuitive and very easy to understand.
The reason why this is like the whole kit and caboodle, because this is not just like stock market. This is like Main Street. This is like how much it costs to buy and sell shit around the world.
Big time.
Crushed.
Big time. And there's an interest rate story in here too. I would say that the two-year Treasury is a more important chart than the dollar. But listen, put that back on for 1 sec, John. Chart on. There is a moment when this goes hard the other way, and no one's expecting it. And I fully expect that to be the next big U.S. stock market rally. And this will have implications for oil. It'll have implications for treasuries. It'll have implications for fund flows, both internal to the U.S. and international. I just don't know when that is. But until that unravels, like, this is the trend: dollar up, stocks down. And I don't know what else you need to know. What do you think about that?
This is it. That's a big one.
Is it right?
Yeah.
All right, chart off. Very nicely done tonight, John. Thank you so much. Guys, thanks for allowing us to debut the new format. And thank you so much to everybody in the live chat. We're laughing along with you. Some great commentary. I'm not going to explain my hair. I'm finished doing that for you guys. Again, no show next week. There will be an all-new Animal Spirits tomorrow morning, and a brand new Compound and Friends will be live on Friday, both podcasts and YouTube on both shows. So stick around, look for those, and we will talk very soon.